Okay. Well, hello, everybody. Thanks for joining us for this session. We're going to talk to you a little bit about deferring capital gains with 1031. And we got a subject matter expert here named Bill. Bill's with Exeter and out of San Diego, and he's partnered with us to be a qualified intermediary in the 1031 and the reverse as well. And my name is Mark Lutze. I'm with LendSure. I'm a regional manager out of the Western U.S. And this is Matt Kirschenheiter, who works for us as well. So we just want to kind of introduce really three programs that we work with at LendSure: the 1031, the reverse 1031, which some of you may not know how that operates, so we can get in a little detail and answer some questions. And then ultimately, kind of a hot product for us right now is a reverse 1031 bridge loan. And so this is for investors that are looking to access their capital on their departing asset to buy before they sell that asset, a new asset, and still receive the tax benefits of doing that. So what I just said is a little complicated. So guys, we're a small forum, so I don't mind if you guys just throw out questions and we can try and answer them on the fly here. We have some detail that we're going to put on display, and it might spark some interest throughout the question. So please do so.
Thanks, guys.
Turned on. There we go.
Thanks, guys. I'm Matt Kirschenheiter. I'm one of the area managers at LendSure, based here out of Orange County. So thanks for attending today. I understand we're up against the how to create a YouTube channel, so appreciate you coming here and learning about reverse bridges. I might have been at the YouTube meeting myself. So, as Mark said, we're a non-QM lender based out of San Diego. A bridge product is a loan we came up with about 2 years ago that we're having a lot of success with, especially in this market here in Southern California, where you're not seeing contingent offers getting accepted. The bridge feature unlocks a lot of potential, taking the equity out of the departure home to bring to the table for a down payment on a replacement property. And we're doing these on investment properties now to maintain that tax benefit. So we're going to talk about a little bit about 1031 exchanges, how it works with the reverse bridge feature, and a little bit about LendSure as well. So this is definitely a product, at least the reverse bridge, focused on real estate investors, your savvy investors, extensive real estate portfolios, looking to buy a replacement investment property while maintaining the tax benefit before they sell that departure property. So we're seeing this scenario come up more and more, right? And especially in this type of environment where we need to pull equity from a departure home to make you a stronger buyer on a new purchase. We're allowing you to tap into the equity of your departure investment property before you sell it, become non-contingent, take that equity, bring to the table for the down payment on the new home, and get you in the new property and give you 6 months to sell that departure home. So it's a really great product for real estate investors, savvy tax investors that are trying to maintain that tax benefit.
This would be Bill's slide, right? Because it's got Bill on it. He's
Yeah, I
there.
think this is what we were going to just kind of put up there real quick, see if you wanted to read through it. It is in the slide deck.
Yes, we'll be providing the slide deck
There's
to
a lot of
everyone.
information, but it really walks you through the computation of the taxable gain to give you an idea of what you're looking at there. But basically, this guy sold a property for $800,000, ended up with a taxable gain of $333,000 after you factor in capital gain taxes, depreciation recapture taxes. This also ignores things like net investment income tax, so it adds up really quickly, and that's really the benefit of the 1031 exchange, is the ability to defer all those taxes. Look at the next one. So this is just a quick overview on 1031 exchanges before we really get into the reverse and the reverse bridge. So one of the things you can do is help your clients quickly narrow down whether or not they qualify for a 1031 exchange transaction. A lot of investors don't really understand what it is, etc. So first thing is it has to be property held for rental, investment, or business use. Anything that's a primary residence or a second home use for personal use or vacation property is not going to qualify. But anything that is rental, investment, or business use will qualify. And so that really defines what we call qualified use. And it's all about the qualified use. And it's all about the intent. So investors give you a call if they're dealing with rental investment or business use property. One of the first things I recommend is shoot them an email and say, have you talked to your tax advisor or anyone about a 1031 exchange? What we're seeing more today is attorneys will call and say they sold property, they reinvested, nobody told them about the 1031 exchange, and now they want to point the finger at somebody. So you don't want that finger to be pointing at you, so just shoot them an email and say, have you thought about that? That way, at least you can say you brought it up. But qualified use means it's property held for rental, investment, or business use. A lot of people get hung up on how long you have to hold title to it. That doesn't matter. There is no specific holding period. What really matters is your intent. Did you have the intent to hold it for rental, investment, or business purposes? The second is like kind. A lot of people get hung up on like kind property. They literally think if you sell a condo, you have to buy a condo. If you sell apartments, you have to buy apartments, and that is not true. Like kind literally means you are selling real estate, you have to reinvest in real estate. So any kind of real estate will qualify for 1031 exchange treatment as long as it's held for rental or investment purposes. That includes things you wouldn't even think of, like air rights and water rights and mineral rights and oil and gas investments and things like that. So it's a very, very broad definition of what you can reinvest in. It gives the clients a really great opportunity to reposition the portfolio depending on what their objectives are. Trading up in value. A lot of the clients that you work with will have specific questions for you when you're helping them decide how to finance the property. And the big question is, how much do I have to reinvest? So just a quick outline there. Basically, they have to trade equal or up in value. There's a very specific formula, but in the short version of that, if they sell for $1 million, they really have to buy one or multiple properties equal to or greater than $1 million. And then they have to reinvest all their equity and, of course, replace their debt. And that's kind of the basic formula. So as long as they're trading equal or up in value, they've reinvested all their equity, the difference is going to be the right amount of new debt on the property. And that's really the formula that matters. So if an investor says, all I have to reinvest is my taxable gain, my equity, it's not correct. It's the top level. The government's really saying, you've got this asset, it's worth $1 million. As long as you remain fully invested at that level, they let you defer all the taxes. That's what it boils down to. Yes?
Quick question. So you said replace the debt. So if you had a $500,000 loan, you have to take a $500,000 loan. You can't add equity to the property.
Good question. So let's use that. You sell $1 million, you got 500 equity, 500 debt. You have to trade equal or up. So you buy into the property for $1 million. You reinvest your 500,000 of equity in the new property. The missing number there is your debt. The debt was paid off on the sale of the relinquished property. You could either get new debt of 500,000, or you can put additional out-of-pocket equity in that. So if you wanted to, you could pay $1 million all cash, have no debt. That would certainly qualify, or any combination thereof. So as long as you've traded equal or up and you've reinvested all your equity, then that debt component could be new debt, new cash, or both, whichever works. Other areas to worry about, deadlines. So when the sale closes, you've got 45 days to identify what you're going to sell. That's the tough part in today's market. It's a tough market, tough inventory, tough interest rates, et cetera, so it moves very quickly. There's a lot of strategies there that we can help the clients with in terms of how do you sell property but not close escrow is one of the strategies. The deadlines do not start running until escrow closes. So if you can get options to extend a long-term escrow, if they demand access to the property, rent it to them, just don't close escrow. Tie up the buyer but don't close, then they have all the time in the world to go out and find property they want to buy. The same works on the replacement property side. If they find property they want, tie it up, get a long-term close, et cetera, and then they just work on timing. It's all about timing with the 1031 exchange. So sale closes, you've got 45 days to identify what you're going to acquire, an additional 135 days to complete the transaction for a total of 180 days. It is not 45 plus 180. A lot of investors think it's both. 45 plus 180, it's not. It's a total of 180 days. So that's kind of a quick 2 hours in 5 minutes. So whoever, I'm not sure who's got the next one.
That's you, Bill.
That's me. So the process is relatively straightforward. First and foremost, this is why I recommend if you know your client's working with rental or investment property, mention 1031 exchanges. The 1031 exchange has to be set up before the escrow closes. The reason for that is the purchase and sale agreement is assigned to the qualified intermediary. We literally step into their shoes as the seller. Going forward, we sign all the documents as the seller. On the closing statement, we are listed as the seller. When the closing occurs, they're going to wire the funds to us and we deposit them into their 1031 exchange account. If the closing occurs without the 1031 exchange in place, it is taxable. There's no way to go back and fix it. And unfortunately, we get those calls literally every week where they say, I closed yesterday or last week or last month, and I just heard about it, or I just figured I would do one now. But when it closes without an exchange, even if they tell the escrow officer, don't disperse the funds, they have the right to the funds, and that's what triggers the tax consequence. So always get the 1031 set up, have the QI, the qualified intermediary, in place, get all the documents drafted, ready to go. Make sure the escrow or closing agent knows it's a 1031 exchange so they don't close until everything is set up and ready to go. That's one of the most important parts there. And then really once that purchase and sale agreement has been assigned to us, everything kind of just flows. Closing occurs, funds are wired to us. That closing is what triggers the 45-day and the 180-day window. But that's when everything starts running. That's what causes all the stress, if you will. And then we'll just hold the funds until they're ready to acquire the replacement property. Same thing happens in reverse. The purchase and sale agreement on the buy side is assigned to us. We step into the shoes of the buyer. The closing statement will show us as the buyer. When the escrow officer is ready for the funds, they'll call us, ask for the funds, we'll get the client's approval, we'll wire the funds directly to escrow. It's important to note that even though the purchase and sale agreement on both sides are assigned to us, we never, in a regular exchange, we never take title to the property. So we'll show up on the closing statement, but legal title is going to go straight from seller to buyer. So it's nice and fairly straightforward. That is totally different on reverse exchanges, which we'll talk about next.
Mark? That's you, Mark.
Excuse me, can I ask a quick question?
Question?
Yes.
On the exchange part, is there like a statute of limitation that if you got the money and it's, oh, I want to do an exchange, so they get one? And is it like a 100 byte rule that after 7 years they can't go back after them anymore? Or what?
It depends on yes. So at the federal level, you have a 3-year statute of limitations, and the state level, you have a 4-year statute of limitations for California. In other states, they're usually 3 to 5 years in terms of statutes of limitation.
I was talking to somebody the other day, said, you know, I got the check, and then I decided to do an exchange. I said, more than 7 years or something like that. Yeah, it's a long time. I said, you're probably the same.
Yeah, after 3 to 4 years, or 3 years, 5 years, whatever it is, you'll be safe at that point. And we've had clients that call up and say exactly that. I got the cash, I did something with it, but I reported it as an exchange. What are the issues? Well, if you're audited, you're in trouble. They'll just disallow it. You pay the tax, you pay interest, you'll pay penalties. But if they don't audit you, then you're good to go.
Quick example of a 1031 exchange in action before we get into the reverse aspect, before we get into the bridge aspect. Property here in Murrieta, California, purchased 15 years ago for $188,000. Not bad, 15 years ago for $188,000. Today, $600,000 value. So after improvement costs, capital gains of $347,000. This house needed some work, needed a new roof, approximately cost $30,000. Instead of spending that on the new roof, this investor decided he wants to buy a new investment property. That property now, again, $600,000, $347,000 of cap gains, cost basis of $253,000. Significant cap gains tax on this. And this is not even mentioning the depreciation and recapture tax. But federal cap gains rate, 20%, California at 7%, you get $93,690 of cap gains on this property. Using the 1031 exchange, you'll be able to defer those and maintain that tax benefit.
So a reverse is basically applying the same logic, but doing the buy before you sell. And so you're going to find investors out there that are looking to strike while the iron is hot. They fall into a good deal. We're in a very competitive market. And so to have a broker that is aligned with these products is really handy for an investor. So what we're finding is the popularity as we go out and market the 1031 reverse bridge, we're actually just doing 1031 reverses for the simplicity of they do have the capital, but they want the tax advantages, but buying immediately. They want that property, they're looking for cash flow, they found it, and they need to strike with iron's hot. So That's essentially why that tool is so handy for you in this market.
So the bridge loan amount is not considered financing on the relinquished property?
It would be financing on the, the departing property. Correct.
It is?
It is.
So you, okay,
It would be like a refinance. It would be treated as a refinance.
okay, so then your new balance on the new property is higher
Correct.
because of that bridge loan, okay.
And which is a good question. There's a lot of folks who will ask, well, wait a minute, I've been told that you can't refinance prior to the sale of your relinquished property. In this case, you're refinancing specifically to use the equity to acquire your replacement property. So that's why it works. And we get a lot of people who then will ask, well, why a reverse exchange? Why would I want to do that? I've heard they're a lot more complicated, et cetera. The reverse exchanges take away a lot of the risk in the transaction, especially in today's market. The risk with a forward, a regular 1031 exchange, is you're selling first, you close escrow, it triggers your taxable gain. And then the question is, can you identify property and close on the property within those deadlines? And if you can't, it's a taxable transaction. There's no way to go back and fix that. If you're still in the 45-day window, you can change your mind, you can identify other properties, but once the 45-day window passes, you are stuck with what you've identified. And if you can't acquire something on your identification list, it becomes a failed exchange and therefore taxable. With a reverse exchange, there is no deadline up front. You can go out and spend all the time you want, find the property that makes sense, do your due diligence, negotiate, go under contract, open escrow, etc. And the reverse exchange actually allows you to close on the purchase of that new property first, and then you've got 180 days to actually close on the sale of your current property. To describe that, a pure reverse exchange, which does not exist, but to give you an idea, a pure reverse exchange would mean you could go out and acquire the new property, you could take title to the new property, you could own both properties at the same time, and then sell your current asset. The IRS does not allow that. So the IRS has set up this parking arrangement where the new replacement property has to be acquired and held, or quote unquote parked, by an exchange accommodation title holder. So that's part of our job. We actually set up an LLC just for the client's transaction. That LLC is assigned into the transaction, which means the purchase and sale agreement is assigned to us. We step into the shoes as the buyer. We're going to sign the loan documents as long as they're on a non-recourse basis. And the closing occurs, we then take legal title to the property. That's the parking arrangement. And the only thing that has occurred at that point is the parking arrangement. And then at that point, it also triggers the 45 days in which you have to identify what you're going to sell, which in most cases they know, so it's just a formality. And it also triggers the 180 days in which you have to close on the sale of your current property. So it does take a lot of the risk out of the 1031 exchange because you actually closed on the property you want. The difficulty is they're more complicated, and the lending component is usually the challenge. So this is a great product where they can actually do the bridge financing. You can tap your equity in the relinquished property to make this actually happen.
And this is where I'm going to interject a little plug for Bill, because just in the last 10 minutes, you can see his worth its salt. The reality is a qualified intermediary is kind of an unusual, part of our entire industry. You don't access them quite often. And so finding a strategic partner that is A, reliable, but B, intelligent and truly understands their role in that transaction. Everything that he just said to some of you might feel a little intimidating. The reality is that these transactions operate just like any other real estate transaction you've already brokered or banked. And the reality is that he's taking on a lot of the burden on some of the structure. And so having that person in your Rolodex is critical, somebody that you can depend on to be a part of that the complexity of the transaction. Question?
So what happens if they never find, like in a reverse, they never find property and they ultimately decide to keep that property? Is there no funding that happens until they purchase the new home anyway, or they can start to incur some costs as soon as you go to reverse?
So you mean they found the replacement
Like,
property?
no, let's say they never find a
Or they
replacement
never find it?
Yeah.
Usually at that point, we haven't opened the reverse exchange yet. So there's probably a lot of questions and answers and discussions, but if they don't find a property to buy, then nothing's happened. There's no fees are due or anything like that. To take it a different level, they find property, we acquire it, we park title to it, and for some reason they can't sell the relinquished property. First question they ask is what happens? Well, you end up owning both properties. We collapse the reverse exchange, we transfer the park property to the client, and they continue to own the relinquished property, depending on what they want to do with that. The good news is there's no tax liability because they haven't sold anything. The bad news, they went through a very complicated transaction and got no benefit.
And from a lending perspective, we're only gonna lend on that bridge property, on the departure property, until we have a new purchase under contract. Right? The only way we're gonna give you the cash out from the departure property, we're also simultaneously doing the underwrite on the new purchase. And we aim for as close to a simultaneous close as possible.
Question. So is that gonna be like 100% cash out? You have to, the whole equity has to go to Newport, right?
So for investment properties, we're gonna go up to a 60% LTV on the departure property. So we're gonna give you 60% of the value of that home, and you're gonna bring that to the table for the down payment on the new home. Everything in the non-QM world is based off of FICO and LTV. So the more money you bring to the table, the better the rate, the better the situation you'll be on a new purchase. But all that money doesn't need to go towards the down payment of the new home. They could do additional things. They could pay off debt, they could furnish the new property, they could stage the departure property to get the best value for it. The best feature of the bridge is it delays that clock, right? It gives you time to sell that departure home. You don't have to worry about short-term moving expenses, and you can get the best possible value for that home if you do have 6 months to sell it.
One of the key features from a renter's standpoint, or I should say a landlord's standpoint, is you're conducting that transaction, but you're also still collecting rents from your departing property with no payment. So even though that you're collecting a bridge loan, and we're going to get to that in a second here, the bridge loan has no payment for that 6 month period of time, and during that period, you're still collecting rents from your tenants. So.
Real quick, I'll talk about the wrap-up process too, because that'll kind of answer part of your question about the equity. So one of the benefits and one of the reasons we want to acquire and hold legal title to the replacement property is the only thing that has occurred up front is the parking arrangement. The actual 1031 exchange has not occurred. So at that point, it doesn't matter how much cash you put down on the replacement property or how much financing is involved, because we haven't done the exchange yet. We've just parked title. Then a few months later, when the relinquished property closes, the funds are going to come to us as the qualified intermediary. The debt on the relinquished property is going to be paid off. Any other debt needs to be paid down on the replacement property side to make sure we have the right amount of equity reinvested. That's when that would occur. So it gives us the ability at the back end to adjust debt, adjust equity, and make sure we have the right amounts reinvested. So it's the wrap-up process that helps with the equity.
And Bill, I'm just going to add one last comment from a lender's perspective. Some of you may want to go search if some of your current relationships from the lending partners you have would be interested in doing a 1031 reverse. And that's what sets LendSure apart, is the simple ability to park title, like he's mentioning, with the borrowers actually being managers of the LLC. Most lenders do not allow that. They would never even consider that risk. So that's something that kind of makes us unique. That's one of the reasons that we have this program.
Very true.
Question.
What type of interest rate are we looking at?
So on the bridge property, the relinquishing investment property, it's a 6 month term, 9.5% interest only rate. So interest is accruing per day from the time we fund that bridge property until it sells, but no payments on that loan. And as Mark mentioned earlier, there are tenants in place. That landlord can still collect rents on that property while it's on the market, while they're moving into the new home, or while they're identifying the new investment purchase.
I just have a general question. Can you take one property and do a 1035 exchange to a multiple properties?
Yes, there's really no limit in terms of how many properties you can sell and how many properties you can acquire. What complicates it is you have to go through the identification process. So the more properties involved, the more complicated it gets, but there's really no limit. I think our worst one so far is one sale, 86 purchases, which is probably not on but it can be done. Yep.
Is the minimum loan amount 750 on these as well? Because the regular LendSure, I believe the bridge loans are 750, or they were.
So for owner occupied, our boost program, which is like a comparable for owner occupied, we actually have a $250,000 minimum loan size for the departing, but our maximum loan sizes can go up to $3 million. So
So on this one, what's the minimum?
Same, it's 250 minimum on the departure. The minimum on the new purchase is 150.
A lot of questions I get from loan officers that have an interest in this are investors that are, they're basically selling off their California portfolio and reinvesting somewhere else in the country. We're in all 50 states. We're going to be able to handle that transaction. Because these are non-owner transactions, if you don't have a state license in the state that that investor is interested in buying, check with Matt, because we allow business purpose loans to be funded in many states that you don't have to be licensed in for those as well. So we can help you out with that.
I'm going to move over this slide quickly. I think it's better if we show this with the reverse feature, with the bridge feature added on, but again, yeah, keep going. So again, the main benefit of this bridge is when we identified that replacement property, let's say that investor is tied up, right? His liquid cash is de minimis, his funds are tied up in real estate. He doesn't have the funds available for the down payment on the new purchase. We allow you to pull the equity from that departure property to make you a stronger buyer on that new purchase. Again, up to a 60 LTV, we can pull from that property. We'll go up to a 75 LTV on the new purchase. And a 6-month term, no payments due. Basically, that clock starts ticking the day we fund the loan until the departure property sells. The other thing too, we're paying off any existing liens on that departure property. That's what's making it truly free and clear. Nothing factored into your calculations or your income ratios on the new purchase. We're removing any liens from that property. We're collecting for taxes and insurance up front at loan closing. That property truly is free and clear. You have 6 months to sell it. All the while you're in that new home, still collecting rents on the departure, and you maintain the tax benefit by kicking that can down the road for those 6 months. The one caveat with us is, as I mentioned earlier, we need to do both loans. Right? The only way we're going to pull the equity from a departure property is if we're also simultaneously doing the new purchase, and we're going to cross default the two properties. That's how the lender protects itself in case that departure property doesn't sell or in case it becomes delisted. Right? When you start offering terms of 6 months, no payments, a lot of things start to pop up out of the woodworks, right? The intent is to sell that property. And again, from a lending perspective, how we protect ourselves is doing both loans and cross defaulting the two properties.
One of the things that we really haven't mentioned is the income doc type qualifications. And all of these products that we have on display for you are DSCR, debt service coverage ratio products. So some of your investors may come to you and ask for the easy doc. That's basically what they're saying.
Can you talk about the benefits of the depreciation that you gain doing these 1031s? The relinquished property is probably pretty much fully depreciated most of the time, is it not?
Depends. I mean, we get clients who own the relinquished property for 5 years, so it's not fully depreciated. But then you get clients who own it for 30 or 40 years or more, and it's fully depreciated. So it depends on the property itself. But let's say you sell a property for $1 million, you buy a property for $1 million, so you're trading exactly equal across the board. The cost basis in the new property will be exactly the same as the old property. You just carry it forward, adjusted for any kind of closing costs. A lot of folks who've owned property for 30, 40 years, it's fully depreciated. They get no more tax benefits. So they may sell for $1 million and they'll buy for $2 million, and now they've traded up by $1 million in value. They have an additional $1 million in cost basis they can now depreciate. So it's a great way to solve that problem. When they fully depreciate the property, there's no more tax benefits. That may be the time to sell, do a 1031 exchange, and trade up, so you've got cost basis to depreciate.
The bottom line, the relinquished property's tax base gets carried over to the new one.
Yes.
Right?
Correct.
With the added selling cost.
Right.
This is an example with the reverse in action here. So quick numbers, that Bozeman, Montana property, fair market value of $930,000. We're going to go up an appraisal value on that departure, right? We need an appraisal on that home. We're not just going to go up the list price. So $930,000 value, we're going to go up to a 60 LTV on that home. I have seen us go higher on these departure properties, but 60 LTV is the guideline constraint. $558,000 loan amount, loan proceeds to the borrower of $558,000. There are fees for this loan. Right? The lender, carrying the risk of taking the equity out of departure property, we're charging 2.5%. We're collecting for taxes and insurance. So that 558 is going to come down a little bit for closing costs and fees. But you're bringing that to the table for your new purchase, right? So we're doing that bridge loan first. We're pulling the equity out. It's a simple cash out refi from an application perspective, just a cash out refi on an investment property. They're taking those proceeds, they're bringing to the table for a new investment property in Lake Tahoe. $1 million purchase price. They pulled out 558 from the bridge property. New loan amount is 442,000. That's a 44 LTV on that replacement property. That rate is going to be in the mid to high sevens on a DSCR loan on the new purchase. So not too bad, especially compared to where agency rates are right now. And this situation arose just because, again, she identified that replacement property first, right? This was her dream investment property in Lake Tahoe. The Bozeman property was going to take some time to sell, take the equity from that home, make you a stronger buyer on the new purchase, get a low LTV on that new purchase, get a better rate on that new purchase, and give you time to sell that departure home.
So one of the things that you see with some of these investors is the complexity of their portfolio and their assets as well. And I do significantly remember this woman had $8 million in liquid investments that she could have just gone a different financial route than utilizing our bridge funds. What was our interest rate on this? It was 9.5?
9.5 on the bridge.
So it was a 9.5% interest, but I basically asked the account executive, why are we doing this loan this way? And it became clear that the asset portfolio was spinning off of like a 16% return. So it made our money almost look free in comparison. Why would you unlock a 16% return to do this real estate transaction when I could offer 9.5? And that's how that investor took it. So the reason I bring that up is that sometimes we don't always look at the full scope of somebody's complexity and maybe even put up our own objections of why you would want to offer a program. This is just one of many solutions that are out in the marketplace today, but it does have some strategic advantages. So just keep it in mind. The thing I love about marketing the bridge loan in this current real estate market is you may not disclose with this program, but you may offer bring up other opportunity, which is regular 1031s, reverse 1031s, and so on. So,
and this is the potential for 3 loans from a broker perspective, right? We did the bridge loan on the departure property, did the new purchase, say 6 months down the line, or let's say we buy down the prepayment penalty to 1 year on that new purchase. They want to move into a more conventional rate. You have that opportunity to get a 3rd loan out of this. On the bridge property, so the relinquishment property, no prepayment penalty, right? The sooner they sell the house, the better. On the new purchase, it comes standard with a 3-year prepay. You can buy that down to 2-year, 1 year, or no year for certain rate hits. So the benefits of the bridge, it allows the investor to proceed with the acquisition without having to sell that original property first, right? Stage that home, get the best value for that property, give you time to not jump at that first offer. And really, if they identify that replacement property first, they don't have to wait, right? They could jump on that property, they could take the equity from the departure and get them into the home they really do want. I think a huge benefit of this is they can still collect rent, right? No payments and you're still collecting rents. Your cash flows just went through the roof. Went too fast, sorry.
Oh, you went fast. No, back. There you go.
We covered all this already. We didn't have to go through all that, but gives them 6 months to sell that home, and yeah, just more flexibility with your options.
So I think we've covered most of this. So in summary, the bridge loan allows the borrower to make an offer to buy another property without having this departure property under contract. Therefore, the buyer and borrower, or the borrower buyer, can make a non-contingent offer in the property, and that's really the key ingredient to today's marketplace is being non-contingent. They're out there fighting for cash buyers as their competition. So when I first rolled this program out, I really looked at the type of investor that would be interested in it most. And I thought it would be the investor that had put all of their assets into the real estate portfolio. So they are asset rich, but they're cash poor. It would be difficult for them to go out and strike while the iron's hot for, a particular real estate offer. And so we do see a fair number of those types of investors, but there are also investors out there that would rather use our money than theirs. And so just to kind of keep the door open to that. Any other questions?
Do you guys have marketing material on this program?
Yeah. So Rose, do you want to speak to that at all?
Like if you're gonna go, I was thinking it'd be cool to go to an investor meeting and just take a bunch of flyers and, well, and put my name on it.
Yeah, absolutely. So we call that like private label or white label, and we do have some of that created for you. And Rose Waldy here, and then Matt can also offer that kind of content to you.
At the end of the presentation, yeah, she won the raffle at our booth. At the end of this presentation, there's going to be a QR code. Take a picture of that. That is going to give you the slide deck. It's going to give you the private label. There it is right there. It's going to give you the slide deck. It's going to give you the private label resources. It's going to give you a guide, a comprehensive, like 24-page non-QM white paper on it. And it's going to give you, Bill, do you want to tell them about your booklet that is included on it?
We'll include about a 30-page guidebook to 1031 exchanges, which covers all the basics. And there's also some hard copies up here for those who might want it. Most people want the digital today, but got some hard copy just in case.
And as you can see that there's some items in the appendix that we didn't go in there, but we included it on there so that you have it on the slide deck and you have it as a reference.
Rose and our marketing team have done a great job with this product. We have a whole database of non-QM private label materials that you guys can customize with your own branding, and not just for the reverse bridge, for the normal primary bridge where the terms are a little bit more attractive, go to a higher LTV on a primary departing property, rates a little bit better, fees are a little bit lower, along with all of our self-employed DSCR, condo-tel type financing options that we have.
The last thing I'll just say is, the more that we've funded with this particular loan program, it really stands out how important it is to have a qualified intermediary that you can actually work with, trust. Some of you guys all have, insurance agents that you refer. Some of you have CPAs that you refer. Some of you have title and escrow relationships. I would tell you that if you don't have a qualified intermediary in your Rolodex, that you give Bill here a shot at your business, because he's a true pro, and we're excited to have him, representing us as well. So, plug. Thanks.
Questions, anybody?
How long does it usually take to close this 2 transactions?
Again, we try to aim them to be as close to a simultaneous close as possible, but for both transactions, they soup to nuts. We do both of these inside of 30 days, and that's with appraisal turn times. We just need to align the CDs and get everything out on the right time frame. So when we actually get conditions cleared, get our CTC, I'd say it's about a 7-day window in order to line those up correctly and fund both loans. But I've done reverse bridge and purchase loans in 26 days is the last one I did, 2 loans. It really depends on the speed of the borrower getting conditions in, as we all know, and appraisal turn times, but I'd say within 30 days we could do both of these loans and no problem. Yep.
I don't have any experience with this product at all, and it seems like a cool product. And my friend here told me that there's another company that does it, but the rates are higher. Are there when you go out and you're informing investors about this product, can you say with full confidence there's not that many people that do this? Are you guys 1 of 5, or there's lots of people?
The specific program that we have up here, I really don't know of anybody that has it. I'd love to know who that other person would be, so that in case Washington what? Washington Fed, yeah, I have no idea that they had it. So, to my knowledge, there wasn't really anybody in the marketplace that has it. It's good to know we have somebody else that's interested in doing it. Our rate is, we're asked quite often, is it like a daily rate? How often do rates change? the rate on this product changes almost never. So I think we've had one rate change in the 6 months that we've had it as a published program. It went from 9.25 to 9.5. My assumption is that would probably be going lower than 9.5 in the near future if rates continue to move.
And if I'm a California broker and they're gonna be selling their California house and they wanna buy a house in Florida, am I able to do that because it's like a non-QM product?
Yeah, so I would have to, I'm pretty sure you're able to do a business purpose loan in the state of Florida without being licensed. So that would be really your question, and we would be able to handle that for both transactions with you as the loan officer, as long as, you know, the organization you work for allows you to do that. Sometimes there's restrictions for certain companies, but if your company allowed that, we would allow that.
We're licensed in all states, and it is a business purpose loan. Florida would be a state where you would not be required to have a license. Some states would be different. From a competitor standpoint, what I have seen, not necessarily with an investment property bridge, but on a normal primary bridge, is the fees are based off of the listing price of the home. Right? And it's usually 2.4 to 2.7%. Right? So that's the cost of doing business, the cost of getting equity from that home. The big benefit of our product is our fee is based on the loan amounts of the bridge property. Right? So if we're going to 60 LTV, the loan amounts and the fee is based off of that 60%, not the listing price of the home. So from a fee perspective, I think we're going to be a little bit more competitive. From a rate perspective, I think we're more competitive, at least in the primary world. And I'm not really coming across any competitors doing this on investment properties.
Your clients need additional tax advice, or they just go with the information you provide?
Good question. They should always talk to their tax advisor. Clients often have some kind of net operating loss carry forward or suspended passive activity loss or something else that could fully or partially offset the gain. So in some cases, clients might be able to trade down in value, pull some cash out and still not pay tax. So very important to know what their tax consequences are before they do anything, and then from there they can decide what's best for them.
What was the circumstance where they could buy down? What would cause it?
They could have a net operating loss carry forward or suspended passive activity loss or something like that that would offset part of the gain.
Do most accountants and attorneys know about this stuff?
About the bridge financing or the 1031 exchange?
Oh,
Both?
yeah.
No.
Probably not.
That's one of my questions was, if you talk to them and they go, you can't do that, like, how do you know?
Yeah, in that case, call us. We'll walk you through whatever you're looking at, whatever the client's looking at. And if it can't be done, we'll tell you. If we don't think it's a good idea, we'll try to talk them out of it. And then we'll, point you in the right direction.
Any other questions?
All right.
You have to deduct also closing costs. You do?
From
You show this.
the 1031 exchange perspective, the actual formula is you take your gross sales price. You don't subtract all of your closing costs, you subtract your routine selling expenses. So your broker's commission, title, escrow, documentary, transfer tax. That'll get you your net sale price. So notice we didn't subtract the mortgage, outstanding debt. You only subtract your routine selling expenses. That gets you your net sale price, and that's what you have to actually reinvest. That's the exact number, the net sale price.
Okay. Well, I think we're at time. So do we want to have any parting words from each of our speakers? Phil, do you want to get us started?
I would say, going back to your question, always have your team lined up prior to doing any deal because stuff happens. And you want to get all your, you just want to have your team ready to go. So whatever comes your way, you're ready for it.
Thank you. Matt?
I took the words out of my mouth on that one. I think when you do come across these scenarios, the first thing you want to do is get the lender on the phone, get Bill on the phone, and get the client on.
You can show this. It's substantial deduction.
And just circulate those parties. Title also needs to get involved, right? There's two loans involved here, title's being held, or you have the QI involved. So it's best to get all those parties involved, make sure that the lender, we're okay with the structure, we're okay with the non-recourse rider, and get these things through to closing. I think one of the other little caveats or the unique factors that we bring to the table is we do allow some financing of points into the loan amount. So you could take your BPC, you could take buy down points, you could take discount points and finance them into the loan amount. Right? So your cash out proceeds are not less. So it's a great feature, especially on purchase loans. You know, keep the borrower, or have the borrower keep that 2% BPC in their pocket at the closing table, finance it over a 30-year loan, put that money to work elsewhere.
Okay.
Not a lot of lenders are doing that in this space. So I think it's a great product, especially in this market where you have to be a non-contingent buyer, a very competitive market with lack of inventory. It's a great solution for tax-savvy investors that are looking to replace their investments.
All right, great. Mark?
And the last thing I'll say is it's intimidating. Everything we just went through for your typical loan officer, this can be, you know, an intimidating topic, but don't let it be. My encouragement to you is you're working with a lender that knows how to do this. Your job is to find investors that have an interest in the product. We have a pre-qual process that we actually take that investor and you through. So by the time that they're ready to really engage into an offer, they know what they're qualified for with us. So we can alleviate a lot of the stress from what you might be thinking could be very stressful. So working with a guy like Bill, you got a qualified QI that does a great job in a lot of the facets that may be complicated and stressful as well. So your role doesn't really change as an originating loan officer. Have confidence and build a team around you to go out and market the program and close some extra loans this year. We all need that. So that would be my influence on you. Okay, good luck.
Do you have any prepayment penalties on your loans?
So investment properties is a 3-year prepayment penalty on a new purchase. And you can buy that down to 2, 1, or no years for certain hits to rate or origination points. If this was on a primary transaction, no prepayment penalty, just a 6-month early payoff period.